I want to thank you all for coming out today, and I hope you'll find the program really helpful. Our panel here, Terry Clancy and Deb Hammond, are very willing to answer any questions that you have. So I will give you a little background about their background. Terry Clancy is a graduate of Loyola University School of Law, St. Thomas University, and Mother Colley High School. She attended Loyola University Rome Center, and she has her own estate planning firm. Before owning her firm, she was a Cook County State's Attorney for 14 years and a stay-at-home mom for 8 years. Her children are all grown, and she's a huge fan of Ina Garten and the Barefoot Contessa. Yes. We didn't ask her to bring treats. Okay, and Deb Hammond is our member, and Deb is a tax attorney, and she has a BA from Illinois State University and a JD from DePaul. She is the Director of Training and Development for Optimum Tax Consultants and a manager of the Jackson Hewitt office in Berwyn. She's been a tax consultant since 1999. So welcome our speakers, and we'll get on our way. Thank you.
Good morning, or not good morning, good afternoon, everyone. I don't know, I suppose I'll talk, and then we'll turn it over to you. How's that? All right, so I think that, I don't want to call you out if you don't have an estate plan. A lot of people sometimes feel embarrassed about that, but you really shouldn't, because I think once you hear my story, you will feel right at home with me. So I wasn't always an estate planning attorney, as you heard from my bio. I was in Cook County State's Attorney's Office for several years, but eventually I just tired of criminal law. And as I was trying to figure out what I wanted to do, my husband, who's a judge, and I didn't have an estate plan, and we had 4 kids and a house and every reason to have had one, and we just never got around to doing it. And so I was thinking, well, if nothing else, while I'm no longer working at the State's Attorney's Office, I can figure this out and create a will for us. So as I was doing that, I realized, wow, this is really important, because I was going to court for some other attorneys just as kind of an ad hoc situation, and finding out that people in probate court can really fight over their parents' money, even if it's all divided up equally. So I started doing more extensive research about doing planning, and a couple friends asked me if I could create their plans, which I did, and I actually drafted one for my husband and I, but he is very detail-oriented and wanted to read every word before he signed it. Unfortunately, that didn't come to pass initially, because on June 7th, 2018, at 11:30 at night, I was woken up by him having a heart attack, essentially. He was gasping for breath, and he was not waking up, and it was very shocking. One, because mostly people don't have that situation happen to them, but also he was in the best shape of anybody I really knew. He had biked that day 50 miles, he had run the day before 10 miles, and he had biked the day before that 70 miles. He was 52 and in great shape. And so I was in shock, but luckily I recognized that something was very wrong with him, and I called 911, and they keep you on the phone if you've ever been in that situation, giving CPR. So as I'm giving my husband CPR, my kids come filing into the room and are pretty dismayed at seeing their mother give their father CPR. And luckily the first responders arrived, but then flatlined on the bedroom floor, which is also shocking. They bring out the paddles, all of that. Luckily they revived him, and they whisked him off to the hospital, and my kids and I follow along. So we get there, and the first thing that the healthcare team asks me is if Mike has a healthcare directive. And pretty embarrassingly, I have to admit, I'm an adult, and I'm in front of my kids, and no, we don't have these important papers, and furthermore, my kids know what I know, and now you know that we're both attorneys, so how embarrassing. So I had to just guess at what he wanted for his healthcare decisions, and off he went into surgery, and luckily it was very successful. He had an angio, he had angioplasty, and he had 2 stents put in to his 2 arteries that were 98 and 99% blocked, and one of them was the widowmaker. But the problem was, even though his surgery was successful, we didn't know how long he had been unconscious and how much oxygen he had been deprived of. And he had never regained consciousness up until that point. So now we waited, and as we're waiting, I'm, thinking of a million things, including, good God, like, I'm not going to be able to get access to any of the stuff to pay our bills if, he doesn't wake up and regain his capacity. And of course, I knew that there's one document called the Power of Attorney Property that if I had him sign that, it would have been no problem. And so, you keep thinking about these things, and then I'm thinking, oh my God, what happens if he passes away and we still haven't done any estate planning? And I know that I inherit half his assets that are individually owned, but my kids inherit the other half. And I'm thinking, oh my God, is there going to be a scenario here where I am going to borrow money from my kids to pay their college tuition? You catastrophize in those situations. But luckily, he's stabilized, and we're going to transfer him to another hospital. And as we're flying through red lights, I'm in the passenger seat of the ambulance, and then Mike's in the back with paramedics, and then another ambulance personnel is driving. And I start thinking, well, what happens if we get into an ambulance accident and we both die, and nobody has created a will to identify a guardian for our one son who's 16? So even though he's not, he's almost an adult and the rest of our kids are, somebody needs to make that decision about who's going to be guardian for him. And it just seemed really irresponsible to put that on our family, or God forbid, a judge just decide that. Luckily, we make it to the hospital safely, and Mike makes a full recovery, such that he didn't even need to go through rehab because he was in such good shape before that. But now there is, little evidence that he actually ever had a heart attack. He's back biking his 70 miles a day, and there is 2 things that indicate that he had a heart attack. One is the 4 bottles of medicine on his closet shelf, and the other one is our estate plan signed in our desk. I think that is kind of the springboard for me to get into this work and become kind of a true believer, because it really is such a small thing to have these documents compared to how much they can really help you out in situations that are as dramatic as that one, and situations that are a lot less dramatic than that. So I was just going to kind of go through the basics of estate planning. I know a lot of you probably already have an estate plan, or I'd like to think you do, but perhaps you don't exactly know what you got there, right? So I think it's instructive to kind of just go through the documents and find out, hopefully you're ticking off boxes that you have these. So the Power of Attorney Healthcare is the document that you use to name someone to make medical decisions for you, and the Power of Attorney Property is what you use to name someone to make financial decisions for you. And then the living will is another medical document that identifies your end-of-life decisions. So it's not a DNR, it's not a do not resuscitate, that is only written by a healthcare team, but it's basically your decision of whether you want to receive a feeding tube if your prognosis is really bad. And then those documents die with you, so people create a will, because it basically lets you name someone to get to receive your stuff. Those are beneficiaries, and name the people who are going to gather and distribute your stuff. Those are executors. So those are the really, really bare bone basics of what everyone needs. But sometimes you have a goal of perhaps avoiding court or delaying distribution to young beneficiaries. And if those instances are what your situation is, you might want to consider a revocable trust or a living trust. So there are 2 different kinds of trusts, essentially. One is revocable or living, meaning that you can change it throughout your lifetime. And the other one's called irrevocable, meaning you can change it, and it's kind of set in stone. And usually the only reason why you use an irrevocable trust is, perhaps you have high net worth and you're trying to get some stuff off your balance sheet so you don't trigger estate taxes. I really am not a big fan, unless that's the situation, of irrevocable trusts, because they are so difficult to change. And most people just can't afford to have their money just not being accessible to them. So the reasons why you would want a revocable trust, I think, are 5 reasons. So perhaps you fall into some of these categories. One is if you own any real estate. I think sometimes there's a misconception, just because you have a will, you're going to avoid probate court. So if avoiding probate court, or having your family avoid probate court is a goal, and you own real estate, that's not going to cut it. You'll own, perhaps with a spouse, you might own your real estate together, and by operation of law, the surviving spouse inherits, but we all are going to die, so that surviving spouse is probably, going to make it a little while longer, hopefully long enough to get everything set up, but one day that person's going to die, and that would trigger probate court. Another one is if you have young beneficiaries. So you probably don't, your kids, if you have kids, are grown, but perhaps you have younger grandchildren that you want to be beneficiaries. So if you put them on like your retirement account or life insurance, they will inherit at 18, typically. Sometimes they'll be as old as 21, but largely it's 18. And so you might want to tell family members who have young kids that, this is the reality, is you don't really want your kids, young kids, to inherit all of your wealth at 18. Usually it doesn't go too well when that situation happens. I have a roommate in college who came into an inheritance when we were freshmen, and it was gone by senior year. So that's another reason. A third reason is if you own a business, because probate court can really interfere with the operation, sale, or liquidation of a business. Fourth is that if you have feuding family members, because a revocable trust will keep everything kind of in-house at the kitchen table and avoid court, which a lot of times, as I said in the beginning of my talk, it very much is a situation that kids play out their childhood skirmishes with their parents' money. And then the last reason is if you're high net worth. So if you fall into any of those 5 categories, you might want to consider if creating an estate plan that has a revocable trust, or redoing your estate plan if you just have a will. And then I think sometimes people, I think at your age, you probably already know who you want to be your person, as far as your medical person, your financial person, your beneficiaries, so I won't talk too much about that. But I think redoing things to make sure they're who you want in those seats. So if you have done an estate plan a while ago, you might want to pull out those documents and just take a look at who you've named to be in those seats and make sure that's who you want. And especially, I would like people to have a backup, because if that person who is your named person, something happens to them, or even if you're with your spouse, so it's your spouse and then one person, and something happens to you and your spouse, and you don't have that person is no longer available, then you're kind of stuck and back where you started. So I like 2 people deep beyond spouse to be named to both financial and medical. And then, if you haven't done an estate plan, I don't think you should be embarrassed. I think there are a lot of things you can do to get things set up, even if you aren't ready to do the documents formally. Clearly naming beneficiaries on all of your accounts. You can do it on checking and savings account as well. That avoids probate court. And, I think sometimes just putting a deadline on your calendar and saying, all right, this is the day I'm going to have my estate plan, I'm going to start, I'm going to get it all organized, and then tell someone that you put that date on there, especially if they're your beneficiary, because they'll be more interested probably in making sure you get things set up correctly than almost maybe sometimes you are. So those are some tips. I think that just kind of looking at what you have, if you already have an estate plan, or just starting the process and not feeling overwhelmed or guilty that you haven't done it, is a really good way to just begin and start moving forward. I know I talked a lot.
So I don't have an exciting story to tell. And in fact, I'm going to talk about something that's not exciting at all, and that is RMDs. And these are required minimum distributions. Anyone who has a 401k or an IRA, any retirement funds, have to have required minimum distributions once you reach a certain age. And it used to be the age was just 70 and a half. And if you failed to take your RMD when they started, when it was your turn to do it, the penalty was severe, 50%. Okay? You could get them to abate it if you discovered your error rather quickly and paid it off immediately, but it's a severe penalty. Well, they're changing that. They're moving it up, so for those of us who had not yet had RMDs, it's passed on to 72, and it's going to keep rising up to 74. So that's a nice change. You can leave the money there, because the required minimum distribution says you have to take money out of your accounts. And when you take your money out of your accounts, what happens? Taxes. Because the money that's in your retirement accounts has never had tax paid on it. And as Albert Einstein said, the only thing you can't escape is death and taxes. Yeah, this money hasn't had taxes paid on it. Anytime you take money out of retirement, there are taxes to be paid. And that's what the required minimum distribution is. And they do a little slicing and dicing and actuarial tables and figure out how long they think you're going to live. And so they want to deplete your assets by the time you die. They want to deplete it. They don't want to build up giant wealth, and that they want to deplete it. They want the money circulating in the economy. They think it's that the people who set these up thought that was a better thing to do. So we have to take required minimum distributions, and you need to take them. Let's say that you turned 72 last year. You would need to take them either by the end of the year or at a minimum before tax day, April 18th. So you've got to take them. You can take them in one lump sum, you can take them monthly, you can take them however you want. And if you need the money to live on, you take the money, you spend it. But if you don't need the money to live on, what are you going to do with it? Well, one thing you can do is if you have stocks, most people in their 401ks or their IRAs have stocks, mutual bonds, something of that sort, you can gift it. You could gift it to a charity, you could gift it to family members, and you can gift it, getting it out, using it for your RMD. The other thing you can do is you could sell the stock and then you can give the money. But one thing that I discovered when we were looking at this was that you can take your stock, if you don't want to sell it, because right now the market is really low, and maybe you don't need losses because you don't have any gains to offset, so you don't want to sell all of the stock while the value is real low. What you can do is you can take it from your IRA or your 401k or wherever, and you can have it transferred to an investment account. So you've kept the stock. You're going to sell some of it in order to pay the taxes, obviously, but you can keep the bulk of the stock if your position in the stock is important. So what else can you do with it? Well, as I said, you could donate it to charities. And the great thing about donating it to charities, let's say you have some stock that you bought for $10,000 and it appreciated, and even with the stock market dropping, it's worth $25,000. If you donate this to a charity, it's going to be valued at its fair market value, the $25,000, not your basis, which is $10,000. Now, if you take stock and gift it to somebody that is not from an RMD, that is not part of your retirement, the person that you gift it to is going to be given your basis. So that stock you bought at $10,000, you need to tell them when you bought it and that your basis is $10,000, and that's their basis as well. But when we're doing this as an RMD, it's not going to be an impact for us. So we can use this, we could sell it, or we could transfer the stock directly. So the RMD is a collection of all of your various retirement accounts. So you need to have the RMD for all of your accounts. But your money can come out of one account or out of each one of your accounts. It doesn't matter. The IRS doesn't really care as long as you do what they want you to do. It's the same when you owe taxes. They don't care if it comes from your W-2 or if you do quarterly estimated payments or what, as long as they get the money. And they prefer to get the money in an equal amounts during the year as opposed to getting it all in the last month of the year. They're not very happy about that. They want to use that money, even though it's yours. So it was something I really didn't know about until I was investigating the RMDs for my husband about the ability to keep the stock, because if you don't need the stock, the proceeds of the stock to live on, what are you going to do with it? Are you going to have to buy new stocks? Interest rates have not been too great lately, although they're creeping up now, which is good for savers, not so good for people buying houses or other things. And so it's something that it can give us another option that isn't talked about a whole lot. So I would encourage you to consider, if you have stocks, whether in your portfolio, your investment portfolio, or in your retirement accounts, to consider maybe gifting them, maybe moving them, rather than cashing them in and having the cash and then having to decide what to do with the cash. So there have been a lot of changes in the tax laws. Every year they change the amounts you can put into the various things, or they change the income limits at which you can no longer put money into an IRA. But they changed a lot of the rules in the IRAs. Roth IRA, you can put money in at any time. You have to wait a while before you can take it out, but a Roth IRA, you've already paid the taxes on that money. Whereas if you have a traditional IRA or a 401k, you have to pay taxes anytime you take that money out. And probably nobody here is below age 59 and a half, so you won't have a penalty. But people who take money out of retirement funds before reaching age 60 are going to have to pay a 10% penalty plus tax at whatever their tax rate is. So that's going to be 20%, 22%, and so on up. So it's something to keep in mind anytime we're touching those retirement accounts, is there are tax consequences, and we need to be aware of them in advance. So I think that's all I'll say, because we're sure that people here have a lot of questions to ask. Marie? Yes.
So you didn't, I don't remember your saying that, so.
Yes, it does increase your income, which is important.
Decreases.
Her question was if you give money to charity from your, using your RMD to give money to charity, it reduces your income, which is great because that reduces your tax liability. Or it impacts what your RMD is. It has a lot of favorable tax impacts on you. So giving money to charity is very valuable that way. And
also, you cannot take a deduction when you give money to charity, and it always has to come from the administrator of your IRA. You can't take the money out. So the plus is it reduces your income. The negative is you can't take a charitable deduction.
That's right, because if you're using it as your RMD, it has to come directly from your plan, and it has to be directly transferred. Certainly, if you give money to charity, that is deductible. But if you're taking your RMD and sending it to charity, it is not going to be deductible. You cannot take it as a deduction.
So how do you go about it? I mean, I'd like to do that. I have no idea
how to begin. Who do I contact to say, yes, I'd like my RMD to go to charity? I call the investment company and tell
Yes.
them that?
Yes, the investment company is the place to start. It's the place to start with a lot of the things. For example, what we were talking about earlier, if you don't have TOD on your accounts, transfer on death or a beneficiary, call your investment company, get that done right away. You can change it when you set up your plan, but you really should have all of your accounts have a beneficiary or a transfer on death or payable on death, depending on what kind of accounts they are. But yes, they're used to doing this and they know how to do the paperwork for it. Just a minute,
I want to verify my understanding. So I understand that if you do this direct transfer of your RMD to some charity, you cannot then put it as a deduction on your taxes. But I want to verify that then I don't get the statement showing that I have to report that income for my taxes for that year. I won't get a
1099-R.
Right. So
Yeah,
then
there's-
I'm paying the tax on it because I won't get a 1099, correct?
No, you'll get a 1099. It's got a different code on it, right?
But I
That I
don't
can't
have
answer.
to pay tax on it?
Right, well, the code that's on any 1099-R depends whether you're going to pay tax on it or not. For example, if you have a 1099-R and it says one is a distribution, let's see. One is a distribution with no known exception. And, that,
Okay, I'm just verifying that if I get the 1099, it's not going to be one that I have to pay tax on. That's all I need to know.
that's correct.
Okay. Right. Okay. And then I had another clarification. When you talked about the Roth IRA, you were saying that then you can take out an IRA because you've already paid tax on it from that RMD?
Well, a Roth IRA,
But you can't take out an IRA unless you're working, right? Yeah, so you can't move any of your RMD money into an IRA.
it's more, yes, you need to do it when you have income.
Yeah.
And, if you have income.
Workable, from wages.
Yes. Earned income is the term of art, earned income.
Usually when the stock market is low, it's a good time to transfer stuff into your IRA because the taxation isn't as high. So, okay.
And the other thing to keep in mind is if people have high assets, you can gift to your children, to your grandchildren, to your descendants, and to anyone you want to, up to the gift limit per year. And the gift limit goes up every year. It needs to be under the gift limit, and if it's under the gift limit, you don't have to do a gift tax or anything on that.
But how do you show that you gifted it to your children? What do you do?
It just has to be under the amount. So this year I think it's 17,000, now adjusted for inflation. So as long as your transfer is 17,000, sorry. As long as your transfer is $17,000 or less, and their transfer from you is $17,000 less, then it's not going to trigger an event in the eyes of the IRS. If you transfer $20,000 to them, technically you are supposed to file an estate gift tax return. You have a $4 million exemption in Illinois. Federally, it's well over 12 million, so most people don't really have to worry. Technically, you're supposed to file the exemption. I don't know that you're going to penalized if you don't, but you're starting to reduce that 4 million with every 20,000 transfer. So then at the end, and you die, and now you have exceeded your 4 million, you're now paying estate tax on anything above that.
I would like to kind of clarify something for this person who said, do I have to put it on my income tax? You actually, on the form, there is a box
for you to put that on your income tax, but next to there's another box, and it states something like if it was a donation or something like that, that you did send it, but you do have to put it on there. But then you have to check this thing saying that you don't owe any tax on, you know.
Yeah, it's a code number that's on your 1099-R, which is why it has to be done by the administrator, not by you. Yeah, so whenever you get a 1099-R, there are codes. 3 is a normal, no, 7's a normal distribution, 1 is distribution with no known exception. There's one for disability. There's different code numbers that go on there, and that controls whether they're taxable. And then when you do your taxes, there's a line for retirement income separate from, say, Social Security, and there you write a word in based on what that code is. But the software will do it automatically.
I think on ours, they just listed as QCD, Qualified Charitable Distribution. So you don't have to count it as income, but you don't get any tax break.
No.
So it's great for charities.
Is there a complication with an IRA being inherited by the spouse?
Inherited IRAs have different rules than your own IRA. Typically, inherited IRAs have to be depleted within 10 years. If the spouse already has RMDs, you have to continue the RMDs. I don't remember all the rules off the top of my head, but there are specific rules for inherited IRAs. And you should be aware that IRAs and 401ks have many, many, many similarities, but not everything is the same. The exceptions on when they're taxable and not taxable are different. And if you want to do the charitable thing, you have to be taking it from a IRA. So if you have money in a 401k that you want to use, you have to go to a bank or brokerage and set up a IRA, and then you transfer it from the IRA. So it adds a little extra step, because not everything that you can do in one can be done in the other.
So before your RMDs are in effect, so before you turn 70, 72, talk about the difference between living off of capital gains versus income, cashing out your 401k or your IRA.
Well, if you have money in a 401k or an IRA, you're not capital gains are not important. They're not taxable. It's not something that's going to hit you. If you have an investment account, capital gains are taxable. Capital gains are if you have an asset that you bought at one price and you sell it at another price, you're going to be taxed on that difference.
But isn't there some limit in the tax tables that you get up to $80,000 for a couple that's tax-free? Is that in earnings or is that capital gains?
That's
the standard, kind of like a standard deduction.
Yeah, that's a limit. It's not necessarily tax-free, no. And the big difference with capital gains is capital gains are taxed generally at a lower rate. They're not taxed at the rate of earned income.
So 15%, but do you have?
It could be 0%, it could be 5%, or it could be 15%. It depends on the amount of your other income, what the percentage is going to be. So that varies, and that's the advantage of capital gains is it's at a lower rate.
But is it 15% regardless of what your income is?
No, it's 0, 5, or 15.
So if you're at 15, I guess the question is, at what point should you live off of capital gains, or should you be pulling out your IRA or your 401k? and claiming the income.
Well,
Is some of your,
It-
I guess my question is some of your capital gains ever advantaged because you have less income? That makes sense?
well, the percentage, 0, 5, or 15, depends upon your other income, depends on your total income.
Maybe that's the question. Maybe the question
You're
is,
right.
when does it go from 0 to 10 to 15?
Oh, I look in the tax tables. I don't even try to memorize any of those numbers because they change every year.
Okay.
And if you try to remember them, you'll remember the wrong one anyway. So, no, that I couldn't tell you. But 81 is a threshold that's out there, 81,000 for a married couple this year. It'll change.
Is there an exemption on residence capital gain? Is there a free?
250,000.
For the sale of your house, yeah, your personal residence that you've lived into the last 5 years, yes.
You don't pay capital gains on that.
No,
Unless it's above 250,000.
right.
Transactions, if that's all he's talking about.
Yeah, stock transactions, there's no exemption.
But now,
Should be.
Let this man.
The question was to point out that there are exemptions to capital gains on your residence up to 250,000. There are no taxable capital gains, but your other capital gains are subject to all the rules that Deb's talking about. And you get a one-time every 5 years. Is that what you said?
You live in the,
250 for a single, 500,000 for a couple.
right. And you have to have lived there 2 of the last 5 years as your personal residence.
Thank you for the information. I think we've had several examples why it's important to use a tax advisor or tax software or a tax attorney or an estate planning attorney. Just briefly, with my experience with RMDs, I have some IRAs at Schwab. They tell me each year how much I have to take out. They give me a checkbook. I can write checks to charities. They don't care what the check, who it goes to or anything. It's the charity that sends me a receipt saying, thank you for your tax deductible required minimum distribution charitable contribution. That's my documentation. If the IRS ever wants to know, do you really qualify as you said on your income tax return? So on my income tax return, I'll say, yes, my required minimum distributions were 40,000. I actually took out 45,000. They say, fine. And of that, what do I get taxed on? Well, maybe only 20,000, because the other 20,000 were checks to church and to charitable club and charities I support. So that works really well. If I gift to my sons, I tell them, remember, this $10,000 is not taxable income for you. Don't make the mistake of saying that. And similarly, we have no problems hitting the limits. So, but if we really want to help them in a way, I can give that 17,000 to my son. My wife can give the 17,000 to my son. I can give an additional 17,000 to the spouse of my son. My wife can give an additional 17,000 to the spouse. So we can, if they need a down payment on the house, we can give them, $60,000 without, or $45,000 without hitting those limits.
Yeah, that's a great way to deplete an estate, to avoid probate, to avoid taxation, and maybe it's when people need the money more.
Yeah.
Maybe it's more beneficial to get the money at that point rather than later. But again, with the RMDs, the 1099-R is what the IRS is going to be looking at,
Yes.
not the little checks that you write. I mean, those are a good record and it shows you which one, but it's the 1099-R that the IRS is looking at.
So my question, and this is going on to a different topic, are there any tips if I want to help one of my 3 children in a business investment? So in this case, is possibly buying some property and building a house on it. Tips for structuring that so that it's transparent to all of my children and having a way that
Sounds
I think the simplest way is, here's $100,000, you owe me 6% interest a year, that's income to me, that's a business expense to you, everybody knows about it, it's payable in 5 years, or if I die, the will or the estate plan needs to say how that affects their distribution of the otherwise equal distribution of the assets. Any comments on structuring that or things to be aware of?
Okay, I'll just say this, I'm not a tax attorney, I've been very much educated by your talk, so that has been helpful. I think what I would be most concerned with is not so much, are you trying to make it equitable, so you're giving money to one son and the rest aren't like, hey, that guy just got. What I tell people is to, I've written it in people's trusts that it's hard to keep track though, so if he's paying you back, and now how much does he owe you by your death, right? And so there's a little bit of an honor system. I suppose you could have a much more codified agreement and have all the receipts and all that. But we've included, in order to keep everything fair, and sometimes equal is not always fair, so I think there's that. I think people, think everything should be equal, and this situation is a little bit different because, he isn't probably more needy for one, special needs or whatever than another child. This is just truly a business arrangement or, a desirous situation. But I think if you codify it and certainly tell all the other kids about it and make sure that it's in the estate plan, like he's going to still owe, he took out this loan, so if the loan is still outstanding, his inheritance is reduced by this amount. Then, yeah, that definitely can be placed in your plan.
Also, if it's a loan, it has to be at the corporate rate, because if it's below the corporate rate, it's be determined to be a gift. It's called a Lincoln loan.
I'd like to ask, we do have an estate plan, but we don't have kids. We have nieces and nephews who live far away, England, California. So who do we choose, to be the people I'm the most concerned about medical, because some of the people I know who need a lot of medical care, their decisions have to be made quickly. And so I don't know if we should look for people here, if we should move to where these kids are, or what we should do. I just would like to know that somebody's watching over us, that's all.
Yeah, so obviously it's always best for medical to be like car right away, right? Your medical person to be a car right away. But in your case, if you don't have a friend or a family member that is a car right away, then you can, I think, still choose somebody who's far away, because maybe that's the person closest to you that you feel the most emotional connection to. But then choose a backup that is closer. Or there's this second document called the HIPAA waiver contact list that people are just starting to use now. And this document allows you to name as many people as you want that can get medical information, but they don't have any decision-making power because a lot of times the people who are on your power of attorney healthcare are also on the HIPAA. And anyway, so the way I tell my clients is choose who you want, and even if your two people on your power of attorney healthcare are not close by, if you have a HIPAA and you choose someone on there, you place someone on there who's close by, they can be boots on the ground and communicating the information to people who are further away. I mean, obviously the best thing would be to have somebody on your healthcare power of attorney who is closer, but if you just don't feel emotionally connected, so maybe you just move there or something, right? You don't really even know your neighbors, let alone good friends to make these decisions for you. Then I would say at least try to find somebody who's willing to be kind of boots on the ground to get medical information so that they can relay that information to your people and then help them make decisions from there. I think it's pretty rare that somebody is going to need those decisions made in the 4-hour plane ride that would be from California to come over, but it's nice to have giving them information all along so when they get there, they're kind of up to speed on it.
Okay, thanks. And then I have one other question, because we did this in 2011 and we probably subtracted twice. So now if we're getting ready to do this a third time so we can change these people, Should we make a new trust? I really don't want to do that because then we have to do a lot of other, like putting the deed of our condo into this new trust. I don't want to have to go through that. I actually don't want to go through any of this, but but it seems reasonable. I think our attorney thinks it's going to look really messy because we've changed it so many times.
Okay, so let's get a couple things straight. So powers of attorney are documents that you wouldn't change, you just redo them. Delete the old ones, revoke the old ones, do a new one. Those don't get amended. And frankly, they should be updated every 6 years, so you're a little overdue. But for the trust, so the trust is vanilla typically by design, and its title never changes. I have a client who's on her 7th iteration of her trust, and she's never had to change her deed because that trust date that you signed it originally and the name that you choose is its name for the rest of its life. So what you're changing, but kind of like a house, that could be the facade. You could change the entire back of it and what we call restate it. And usually when you're restating it is because you're changing people in seats. So trust, not trustee, but trustee, the successor trustee. Changing the beneficiaries is not typically a reason to restate the whole trust. You can just amend it unless you've amended it 3 times before, and now you're on the 4th amendment. So then you kind of, in a way, you're throwing out the old and starting with the new with restating. I like to think of more you're building on top of it, but really that's the most recent blueprint. And so they really shouldn't have to look to any other document if that one is completely speaking to the issue that, so I think I covered all the.
So the problem with that is if it doesn't say on the document, or let's say your stock account or your checking account, that it's been restated, how will the bank or financial institution know which is the most current though?
You're giving them a new copy. So you're gonna, if you restate it, anyone who.
Yeah, but what if child A and child C have different, the oldest one who lives in England only got the first one, then it's been restated 2 or 3 times, and the current kid has the restatement. What if?
Well, they should share the restatement. I mean, it's gonna have a number on it, and it's gonna have a most recent date.
I know, but what if kid from England comes in and wants the money? Then if it doesn't say that it's restated.
Well, the trustee has to find, when the trustee's administering the trust, because you're no longer able to talk to them about it, right? You're no longer the trustee because you're dead. And now the successor trustee is administering the trust and doling out the money and paying all the bills and all that. It's their obligation and really yours to make sure they have the most recent copy.
Yeah.
And to use the most recent copy, make sure, sometimes it's just a quick amendment. So really they're using the copy before that to identify who's the trustee. If the amendment is just saying, adding 6 charities. So they need to find the most recent copy. Everybody honors the most recent copy. There's no argument by somebody that says, oh, well, she, unless there's an incapacity argument, oh, well, the thing she signed 10 years ago is really what she wanted, and the thing she signed yesterday is not what she wanted. Nobody's gonna, there's just no argument for that. I think I'm answering your question.
Yeah, and I also would make a comment about keeping every single trust copy. Don't get rid of them. When I finished my father's estate, lawyers wanted, the first one, and the second one, and the third one, and they wanted copies of all of them. So don't throw them away. Keep them all.
And when you're saying copies, do you mean the restatements? I do that. I like to build on top because I've actually handled an appeal where we had to go back because there was a lot of argument about intention, second life, all that kind of stuff. But mostly some lawyers shred old copies. And then there could be floating around, so you could still have this problem, which is why I kind of like to stack them on top of each other and just so that everyone can see. But I think I like to keep it all in a binder. It all is in one binder. They're all tabbed. They're all super organized. And digital copies are another problem because really that's what we're gonna be seeing. So you've gotta make sure that if you restate it or do an amendment, that digital copy goes to wherever the other digital copies are too. So, yeah.
Don't these documents get recorded?
A trust does not get recorded anywhere. Banks and financial institutions will want a copy of the trust typically. When you record your deed, there's no trust document that gets recorded with the deed, that's just the title. So the only way this really gets brought into the public is if it gets disputed in court. The hope is that, that's the whole point of it. You're keeping it private. Nobody really knows except the beneficiaries and the trustee. Some states, you have to distribute a copy to everyone who's who's a potential heir, but that's, not true in every state.
Is a 529 made to an adult, already educated child considered a gift?
Oh. So, explain the situation a little bit more. So you are the owner of the 529 and you give your son is the recipient and now he's adult, he doesn't need the education money and now you're giving the rest of the account to him?
They could either convert it at some point, because I think the law has changed on that, or they could use the proceeds to pay for their child.
Yeah, so I think if they're using it in an educational way, then I don't think there's going to be any tax. I am not completely adept on 529s. I have to say.
Do you understand the gist of my question, though? It's sort of a way to avoid the gift.
Well, I think if it's always being used going from the account to an educational platform, I don't think you're going to pay any tax. It's when you're pulling it out and withdrawing the money without writing the check to a educational institution or whatever those other exceptions are for education. When you're using
if the grandchild used it, it wouldn't be subject to that tax then, right? So
you can hand them down as long as it's education focused.
If you have beneficiaries on all of your accounts, but if your will says to give 1% to this person, to this, you have like 8 people you're going to give 1% to, where does the 1% come from if you have beneficiaries on your account?
Nowhere. They're getting nothing. So, and I should just point this out. So two situations trigger probate court, or one is a real estate that's owned individually typically. There are some loopholes around that, but largely that's triggering probate court. And then the second is assets that are more than $100,000 altogether, but that aren't beneficiary designated. So in your instance, the beneficiary designation rules, so the only way a will would guide anything is if it's not beneficiary designated. So, like if you win the lottery and get hit by a bus, now the will's gonna guide that money because you haven't received it yet. But if it's in an account and you beneficiary designated, then it is going to that beneficiary. And this is a caveat for those who have trusts. And sometimes, and I think somebody said something about, I knew I had one more thing. So you said you bought a new condo, but you didn't put it in a trust, and that is a terrible decision. You should definitely put it in your trust. You just need to retitle the deed. Oh, you did? Oh, okay. Oh, good. No, you don't. No, you don't have to do it. That woman who did it 7 times, she deeded it once, and she's redone it 7 times, and we've never had to change her deed. But here's a caveat. So I had a client, his mom put her house in the trust, which was great, right? They're avoiding probate court, but she never got around to putting anything else in the trust. She was supposed to beneficiary designate some bank accounts to get, a little bit of wiggle room so that the trustee can now pay the taxes, pay the utilities, whatever, have a little wiggle room to deal with the house so that he is not pulling it out of his own pocket in order, because he didn't want to sell the house right away. And unfortunately, his mom had beneficiary designated everything to a granddaughter who, you know, was young and wanted the money, as you can imagine. And so the son is like, hey, you know, we need that money to pay the bills for the house in order for us to, you know, get to a point where we can sell it. We wanted to fix up the house, whatever. And he's like, well, we'll give you the money, you know, after we sell the house. No, she wouldn't give it to him. And so he had to pay for all, you know, it'll eventually come out of the sale of the house if he has put his own money in. But, you know, nobody really wants to do that. It would be nice to have a little buffer in the trust so that you can, the trustee can kind of move money around so that they don't have to have this situation.
Also, doing everything with beneficiary designation maybe isn't the smartest thing.
Because you have no
Thank
liquidity.
you. Actually, that's my question, is when do you designate the trust as a beneficiary, and when do you designate an individual as a beneficiary?
Well, retirement accounts will always have individuals, for the most part. It's definitely spouse first, because as we heard, they have a nice tax deferral status. If you aren't taking your RMDs, I'm pretty sure you can just kind of make that IRA your own, and you can continue to contribute to it if you're working.
No.
No, that's wrong.
It's got to be separate from your own individual ones, but it's yours and you can keep it.
And can you contribute to it? No. Okay. Anyway, so your retirement accounts, the times where you would want to beneficiary designate a retirement account is if your beneficiaries are minors or just young or you know, not good with money, because in the trust, you would be able to put some stopgaps on when they would be able to inherit that money. With the retirement accounts, they're just going to inherit it somewhere between 18 and 21. So retirement accounts largely no, except for those exceptions. And then you know, definitely want to beneficiary designate your checking account. Largely you don't put that in the trust, because if you have direct withdrawals and deposits set up, most banks make you change bank account numbers, and now you've got to set all that stuff back up. So as long as you put a POD, which is a beneficiary designation for bank accounts, pay on death, you can have that, you know, like your checking account go into your trust, and now that's giving some wiggle room to the trustee. And you know, you also can beneficiary designate any other account, but most estate planning attorneys like you to have taxable accounts, so savings account, CDs that have matured, or brokerage accounts. That should all be in the name of a trust, because this gives your trustee complete access to that money when they need it. Otherwise, things that are beneficiary designated to the trust will eventually make that way to the trust. But if you're alive and somebody needs to get into that account, they're using the power of attorney property document to do it. They still have a way if you have a full estate plan, but that power of attorney property document, banks hate them. They don't feel indemnified by them unless you've signed their own power of attorney property document, which usually has an incredible indemnification clause in it. Anyway, so the best thing is for taxable accounts to be in the name of your trust, but if for whatever reason you don't want to do that, at least beneficiary designating them to your trust is the least you should be doing.
And another thing is often wills are called pour-over wills, so that if you have something that's not in your trust and it isn't in trust name, if you have a pour-over will, it means everything from your will or estate goes into the trust.
Yes. And so what I tell people to do, and it doesn't have to be complicated, but just make a spreadsheet, for lack of a better term, with 2 columns. One is what you own, and 2 is where it is. Is it beneficiary designated? Is it in the name of the trust? Is it beneficiary designated to the trust? So now you can tell for yourself, oh, I have that checking account at Chase, and I've done nothing with it. Nobody is on it with me. And now I've just dumped $50,000 in there, and even if that doesn't trigger probate court, it's a pain in the butt to have to use a small estate affidavit, get the will filed at the clerks, I mean, it just is more work than for you just going to the bank and putting a beneficiary on there. So, needless to say, you yourself will know what you own, where it's held, how it's held, and then, you know, you can keep that very simple list for whoever comes up behind you to handle your stuff. And you don't even need account numbers on there if that worries you. You know, I think, because people sometimes when they don't know what you own, they're digging through tax returns to try to figure it out. I mean, it's you know, an unfortunate situation.
And do you want to talk about the step up in basis that date of death?
Oh, so I just had this call recently. This woman really wanted her daughter to inherit her house. And I said, well, you know, if you bought your house when, you know, a long time ago, you want to have your daughter inherit your house a different way than putting her on a deed, because that way, when you inherit something, you get a step up in basis. That's not true on every piece of property in the country. It is on your Illinois property, but in California, you only get one step up in basis. I think they recently passed that law. Anyway, so if your child inherits your house and it's worth $500,000 now, but you bought it at $100,000, they don't have to pay the capital gains that you would normally have to have paid, you know, last $250,000. They wouldn't have to pay that capital gains that you would pay when they inherit that house. And that's true for accounts as well, except for retirement accounts.
Could you try that again? So you own it, primary person owns it, and they bought it for $100,000, and now they're going to give it to their daughter.
They can't give it to her. She has to inherit it. You have to die to give it to her.
So what does that title say?
Well, it's
she's going to inherit it. What is that vehicle to give it to her?
Well, you're going to either put it in a trust. I mean, frankly, if she inherits it through probate court, she's still getting a step up in basis.
Okay, so whether the title is in the trust or her name is on the deed?
No, you don't want her name on the deed. Then she doesn't inherit, doesn't get the step up in basis. So don't put, and plus you attach all her debt to your house.
So your house is titled with your trust, and then you die. And then she's going to inherit the house at $500,000.
And the value is at the date of your death.
Okay, so they make a
fair market value at
market
date of
value
death.
with your accountant or whoever, and you say, this is what I inherited it at, and then the daughter's gonna own that, so does she have to hold on to it at a certain time to sell it? Or
No, so you know, she could keep it in the trust. I mean, it could just stay in the trust. She's the, you know, it doesn't have to come out of the trust unless she's gonna sell it.
Yeah.
But when she sells it, whatever the increase in value from the day of your death to the day she sells it is what she's going to be responsible for.
Exactly. Does that make sense? Okay.
And also with spouses, if your husband dies and you own a house, half of the house gets his step on basis and his date of death. So if your house is worth $500,000 and when he dies, then $250,000 of that goes into a new basis. Okay. Somebody else up here.
I have a couple of questions. One, how do you find a tax attorney to write a will? And two, how much should you have before you consider putting it in a trust?
Okay, so it's not a tax attorney, it's an estate planning attorney, and here I am. You found me. And then how much do you have to have? So, like I said, 5 situations are worthy of trust. I mean, there's probably plenty more, but at the very least, if you own any real estate, if you have young beneficiaries, if you have high net worth, if you have a taxable, or not taxable, if you have a business, or you have feuding family members. Because if you don't have any of those things, you could probably beneficiary designate everything And, then it's really just your personal property at that point.
Did you say feuding?
Yes, feuding family members. Because if your family members disagree on how everything should be split, especially, if you just have a will and now they want to contest the will, or if somehow your assets trigger probate court and now they're in court to get them divided, even if you don't have a will, they can just run up the bill.
All right, what is high net worth? What figure are we talking about here?
Well, over $4 million, but really, for smooth operation, I like a trust, because like we talked about with your beneficiary designating everything, who's gonna pay the bills, how's that gonna happen, I think it just is nice to have one person in charge that has some of your money in order to facilitate those end-of-life situations that, the people just kind of want to tie up loose ends.
I'd like to add to your list, we have a blended family.
Oh, blended family, yeah, that's a very, very, yeah.
We have yours, mine, and ours.
Yeah, blended family is also even if they're not feuding, because equal is not always fair, and so that's one situation that usually equal is not fair.
So beneficiary designating sounds cumbersome. So if I have $4 million on high net worth, to use your number, and I want to give 1% to 5 of my pet charities, how do I make that happen smoothly? Because there's going to be a variety of asset classes, correct? There's going to be real estate and stocks and different things that aren't going to, I would have to liquidate it all, is the only way that I can see this, to make it go to these other places, unless I were to say, take some stock and give it in kind to, do you understand the gist of what I'm saying?
When you're beneficiary designating, you're usually just doing percentages. A lot of times it's just kids equally, or, this 5 charities equally, or even you can do, it depends on the financial institution, on their tolerance for your beneficiary. They might have a limit, but you could. If you have 100 charities and you say, I want my $100,000, $1,000 to go to each of these charities, here's the list, please put it on as a beneficiary. I don't know that they'll do that for you, but.
That list exists for every asset that I have, though, no?
Yeah, so, this is another reason to do a trust, because what happens in a trust is everything goes into the trust, it all gets liquidated to one number, and then your beneficiaries, you've identified the percentages. Usually you're not giving one stock account to one person, another stock account to another person. It's all typically getting liquidated, and then it's getting divided.
Well, wouldn't you be passing some of the assets down to your heirs via the?
Well, you've named them in the trust. Who's going to get what?
Right. So, but I wouldn't be liquidating in that case.
Well, you're gone, and your trustee has all these assets, and unless they're a really good, it would just be too complicated to give somebody part of one account and part of another account and part of another account. For simplistic sake, they're going to liquidate it all. I hate to tell you. Yeah, the trustee.
Well, one of them was answered about your threshold, but I did get confused when you were talking about this, I don't remember the technical term, but the selling the house to the daughter thing.
The step-up in basis?
Step-up basis. But if your total account is not over that 4 million threshold where you have to pay estate tax on it, but the capital gain, if it's not, let's say I inherit from somebody and I sell that house, it was not going to push me over the 4 million. It doesn't matter what the step-up basis was.
I don't know where what your concern is, why you wouldn't want to trust.
No, just you confuse me that we even have to think about step-up basis, because if you don't hit over that threshold of what somebody's going to inherit, it doesn't matter.
Well, if you put them on the deed now while you're alive, I think that's some people just say, oh, well, I don't want to have to bother with all that other estate planning stuff. I'm just going to put my daughter on the deed, and she'll just inherit it as if she was my spouse.
So you were talking about why it isn't a good idea to put it
Right.
on the deed. But you don't really, if you're not over the 4 million, you don't really have to worry about this step-up basis for the sale of a house because there will be no capital gains that kick in.
No, you're confusing two different things. So the 4 million is estate tax that but capital gains. So if you put your daughter on your house, you die, she inherits, and now she sells it 15 years later, but you bought it 10 years before that, she's going to pay the capital gains for that entire time.
Okay, so that's the assumption that when you die, your house is not going to be sold right away and be part of the estate. Because when my father died, I have 8 siblings. We sold his house. We each got a portion of that sale, and there was no issue about step up or any of that because it was under the limit of what we could inherit.
Right, because you inherited through death. I'm saying if you're giving somebody during their lifetime and you're both alive, then that's when capital gains become an issue because you don't get that step up in basis until death.
Got it, but I thought it was the same thing, a washout, but I guess I just misunderstood because she's gonna hold on to it. No, but we're not talking about the title anymore. You're saying we have to worry about this capital gains thing, even if she's not on the title, because she might sell it 15 years.
No, that's not true. If she inherits
through death,
she gets whatever the house is worth at the date of your death. Now she can sell it right then, no tax involved.
sell it 15 years later and there's no step.
No, if she sells it 15 years later, it's now her asset. So if she has grown the house is now 15 years later worth $300,000 more than the day of your death, she is paying the capital gains, notwithstanding, we're not talking about the $250,000 or anything like that. She's paying the capital gains. Say this is a second house for her. She's paying the capital gains on that $300,000.
So tell me then, why didn't we have to pay capital gains on selling my father's house? Because we didn't.
You inherited it right away and you sold it right away.
Well, what is the right of way definition then? A year?
However, the house didn't go up in value during that time that you tried to turn it around and sell it.
Okay.
Okay.
Plus, is it still true that you can value it at date of death?
It's
or 6 months
complicated.
later?
I agree. It took me forever to figure that out.
I don't know.
So,
Valuations, I thought it was date of death.
IRAs, Roth,
Used to be there was a
401k, blah,
choice.
blah, blah. What do I take, what's the level? Which one do I take out of first? Because I think, right, you could choose where your RMD comes out of?
Yes, you can choose where it comes from, but you have to hit the mark, which includes all accounts. So it includes all of your accounts to determine what your RMD is going to be, but it can come all out of one account or out of each of your 5 accounts. Yes.
And which one is the one that I want to take out first? Which one do I want to deplete first and take my RMDs out? Does it matter? I want to take it out from the one that's not making as much money, right?
Yeah.
Okay, is that the answer?
Yeah. Or you could take it out of the one that has grown the most, because you want to make sure that you don't have capital gains issues at some point.
Okay.
But yeah, no, it can come from one or from all of them. Well, yes, you have a required minimum distribution based on all retirement accounts, but
I can't say I'm gonna take the value of that all from one and not take it from the other companies.
yes.
None of them gave me that option at all.
Well, but did you tell them, I'm not going to take it because I'm going to?
Because I didn't know I could do that, but then how does the IRS know I'm not in default on those? They're gonna.
because the question for your tax return is, you know, what is your RMD? How much did you take out? And as long as you take out whatever your RMD is or more, you know, and sometimes, you know, you're going on a cruise down the Nile and so you take out, you know, $10,000 extra or whatever. That's fine. You can take out more, but if you take out less, you have a penalty.
And is that true if I have both my own and an inherited IRA, that I don't have to necessarily take it from the inherited one? I think it's probably not the case.
Probably not. I don't know the answer on that. When you inherit an IRA, it can become your IRA, but you can't continue to put money into it. But you can take money out, and generally they have to be depleted within 10 years.
Is that true?
I have one more question back to the gift thing.
I'm not positive. I think it's tax. I hear it is.
Here was talking about the whole gift to your children. I just want to verify, they don't have to report it as income, but I still would have to pay tax on that if I took it from an RMD, correct? It doesn't give me, it's not like giving to a charity. It doesn't give me a non-taxable status.
No,
Okay.
no.
I didn't think so, but I wanted to.
But what it does is it depletes your estate, which may avoid taxes at that point. You know, you're getting rid of
If you're above 4 million when you die.
Yeah.
I don't see how it would avoid taxes. When I take it out, I have to pay the tax on.
Well,
That's income tax.
income tax.
Yeah, income tax.
And
Oh,
and
I'm
it
not
dep-
gonna have enough to worry about estate.
Okay.
Yeah, I don't think you.
Okay, I think we can take one more question, but I at least have to get back to work.
Yeah, me too.
Can I just clarify two quick things? So, a trust doesn't have to be filed anywhere.
Nope.
So where does it sit? In my safe or?
No. No safe, no safety deposit box. It has to be somewhere that somebody can get access to it. It typically doesn't, besides your name and your heir information and your trustee information, you don't have to worry about somebody breaking in your house and taking your trust document. I don't, because, frankly, it can be reproduced, unlike a will that some people say put it somewhere safe, but if you have a trust, the will has such less importance that I don't even know if that's necessary. So I would say you just keep it in a place that's accessible to your trustee.
And digital is fine?
Digital, yeah. Mm-hmm.
So, last quick question. You don't have to redeed a house to put it into a trust?
You do if it has never been put in the trust in the first place.
You do, okay.
You know what, I had my children meet with my attorney, and I thought that was helpful, so that they would have things explained to them too. Sorry about that, all right.
That's an excellent point, because a lot of these people are knowledgeable, but they should contact an accountant or an attorney, and some of them will give them the info pro bono, no charge.
Yeah, so if you have a trust, just think, what's in my trust, and is everything I own either in my trust, beneficiary designated to my trust, or beneficiary designated to somebody else? And if you don't have the answer, except for a car, that's probably the only thing you just keep out of your trust and don't do anything about, unless it's going to be worth more than $100,000 someday. All right, with that, we're going to conclude.
Thank you